retailers, after the initial knee-jerk reaction, have come to a conclusion that things are not so bad?
We are advising investors that sort of a slight rebalancing of their portfolios, don't get overly exposed on industrials and infrastructure. We believe that theme is also going to continue, but probably need to rebalance your portfolio a little bit and make it more well diversified.
All the experts have been saying that the markets are likely to be bullish, but if there is an indication of any sort, do you see any changes likely to happen in the next few years?
Because of the fact that tax changed, the one big thing that everyone missed or kind of noticed but did not pay enough attention to was the fact that we are firmly and truly on the path of fiscal consolidation.
Hello and a very warm welcome to this special post-budget coverage on Mint in partnership with HDFC Securities. In this session, we will dive deep into the intricacies of the latest fiscal blueprint laid out by the Indian government. We will break it down to see the key provisions, policies and reforms introduced in the budget and analyze their potential impact on various sectors and the everyday lives of citizens. There has been a stream of views that are flowing around about taxation, angel investor taxation, LTCG, STCG. But how can we organize the right insights that can help you manage your investment decisions better? To help simplify those, we are joined by three very seasoned market experts. Welcome, gentlemen. Welcome to the show. So on my right, Deepak Jasani, who heads the retail research team at HDFC Securities, where he guides the team in equity and equity derivatives and fixed income. Unmesh Sharma, head of institutional equities. Unmesh has a rich experience of over 20 years in the field of capital markets. He heads the institutional equities business. He has worked across the capital markets verticals, of course, and we also have Varun Lohchab, head of institutional research, and Varun is currently heading institutional research at HDFC Securities. Total work experience of 20 years, out of which 17 years in Indian equity markets across buy side and sell side across a wide spectrum of sectors. Thank you so much for your valuable time. So what I'm going to quickly do is give our audience an overview, and then you can of course decode all of it further. So the priorities listed by Madam FM have been productivity and resilience in agriculture, employment and skilling, inclusive human resource development, social justice, manufacturing and services. Infra is seeing of course a lot of investment, urban development, energy security. In energy security, we're also looking at renewable energies, etc. And EVs are getting certain attention. Of course, innovation, research and development and next-gen reforms. Now, the basic numbers are standing at 48 lakhs crores, the total budget expenditure. Fiscal deficit target is 5.9% of GDP. Capital expenditure allocation stands at 10 lakh crores, a 30% increase from the previous year, and primarily because we are focusing on infra development. Healthcare sector allocation is about 87,000 crores, including significant investments in public healthcare infrastructure and health insurance schemes. Even though it's up by double digits, but India continues to fall short of the target set by the National Health Policy 2017 to allocate at least 2.5% of GDP to healthcare. So we will talk about that as well later. Education sector allocation 1.48 lakh crores with a strong focus on digital learning, skill development and research initiatives. I think that's the demand of the hour. Skill development is so important. Infra development and allocation of about 11 lakh crores for capital expenditure, which is 3.4% of GDP, which has been made this year. Renewable energy and green initiatives, as we spoke about, 19,000 crores allocated for these projects, including solar and wind power, and of course additional incentives and tax breaks for EVs and green energy investments, the last two being defense budget. 6 lakh crores with focus on modernization and self-reliance, and social welfare and inclusion stands at 13,000 crore for welfare schemes, with about 50,000 crores for affordable housing projects. So mota, that is what is the lookout. But we will talk about retail insights so that, of course, the idea is that whoever is watching us today is able to understand in very simple terms that what has happened, because a lot of times when the papers even comes to us journalists, especially the PDF that comes, it is so difficult to go through all the appendix and all the indexes and everything. So I think what we'll try and do is simplify it, what it really means for us, the Aam Janta, and how we can sort of make our decisions that are related with our investments. So let me start with you, Deepak, and gentlemen, feel free to chime in anywhere. How do you see the impact on retail investors and specific measures that will directly benefit or challenge this group?
I think it has been about a few days since the budget was introduced. We saw some initial negative reaction on that particular day because of the hike in capital gains tax and STT, mainly because of those two reasons. But I think the fear was overcome very soon. We ended almost flat on that day, and post that we have been the markets have been rising gradually. So in that sense, I think retailers, after the initial knee-jerk reaction, have come to a conclusion that things are not so bad. What the initial impression about the budget was not warranted. There has been increase in STT and capital gains tax, but that is not going to materially impact the retail investor unless you are a very active trader. And that too, I think the impact on very active traders also will be offset or maybe overcome in a couple of months' time, because people are very adaptive. So they will get used to the new scenario, the new taxes, and then evolve new models. So in that sense, the Aam Janta or the Aam retail investor is not going to be so much impacted by these changes. Having said that, I think markets are at a very at a high level. It does not mean that there is no upside from here. We are still cautiously optimistic. There may be still some upside left in the markets. But given the high levels, I think it is a good time for retail investors to do their asset allocation review. If the equity proportion has gone up due to rising equity values, then it is a good time to readjust that, bring down the equity proportion, and reallocate that to either gold, fixed income, real estate, or whatever other asset classes they are short in. Plus, whichever stocks they own have run up very sharply over the last few months, you may evaluate that whether those stocks justify that kind of valuations. Maybe take some profits out of that, not entirely, but some profits out of that, raise some cash, so that cash can be redeployed whenever there is weakness in the market. So I think those are the things which retailers may do at this point of time and prepare for the next few months.
If I could get the two of you chime in from your experience, which sectors do you believe have benefited the most from this budget and why? And also, are there any particular sectors that retail investors should focus on post-budget? Like Deepak said, that you have to reevaluate stocks that you were holding, perhaps is now the time for diversification. So should they be considering other sectors? Because infra was doing very well any which ways, and again there's investment, but what would your deliberations be?
Sure. So, if you look at, as you rightly said, the government's focus on infrastructure has been there for last 3 years, and actually last 2 or 3 budgets were talking mainly about infrastructure. This time around, what we sensed, and clearly, directionally it seems that this was a more balanced budget, in the sense that while the thrust on infrastructure continued, but the government talked a lot about other aspects as well, like upskilling of and employment generation, which is probably the number one sort of problem or a headwind which our economy could face over the next decade. So they are now trying to address it. So last couple of years we have seen markets, a certain pocket of industrials, infrastructure, manufacturing was the only pocket which was delivering, along with real estate. Now we believe new sectors which could be looked at is possibly related to PLI and all would continue, but something related to consumption, because once this job creation happens and more money comes in through employment, consumption is going to pick up. So one needs to rebalance their portfolios a little bit more. Anyways, valuations in a lot of the industrial sectors had gone through the roof. So consumer was looking better, and maybe look for some new business models which would come up in terms of this whole skilling of the workforce which is required over next 10 years, and this is going to be a long term theme, not a 1 year or a 2 year story. So then possibly some more money going towards the government priorities toward digitization of all the records, like on the land records. So business models which would benefit from digitization over a period of time. So IT related businesses, but it's gonna be very stock specific and business model specific. So we are advising investors that sort of a slight rebalancing of their portfolios, don't get overly exposed on industrials and infrastructure. We believe that theme is also going to continue, but probably need to rebalance your portfolio a little bit and make it more well diversified. Anyway, given where markets are, given where valuations are, as Deepak said, one has to be cautiously optimistic. One can't be, outrightly optimistic in this scenario, and therefore, risk management through a very well diversified portfolio. Don't be overexposed to only small caps or mid caps. So it has to be well diversified across market caps, across sectors, and then evaluate every stock that you are buying in that sector. So I think the days of easy returns that you buy anything and it goes up may not be there in the next couple of years, but does not mean that everything will go down. There will still be stocks and maybe certain sectors and long-term themes which will continue to do well.
Umesh, market was anyways doing well, was quite bullish. Sectors have been, whether it's defense or IT did, was a little unstable for some time, but picked up. Defense has been the one sector that has been doing continuously well, right? Allocation is also high there. But other than that, now that there is, like Varun also said, education's gotten a good headway, health of course, but do you see any other sector, infra of course, but do you see any other specific industry sectors where if we have to do sector oriented investment, then what would your advice be?
Yeah, so interestingly, I think if I sum up what both of them were saying, what we've noticed is that a lot of so we don't cover any defense stocks, but at the same point in time, if you look at absolute valuations basis, what is publicly available, a lot of these themes have run far ahead of themselves, and
true.
That is actually what
it's
Deepak is
surprising,
alluding
yes,
to as well. But that's the nature of the beast. If I take a step back, what is the market doing here? There is a huge financialization theme running right now. Now, when this theme, if you compare it to what happened in Hong Kong, China in 2003 to 8, is that when a flood of liquidity comes in, what people do is that they take valuations higher, which is what's happening, and then themes become bigger than earnings.
Yeah.
And that's what's happened, I think, to defense. What I think, however, we can notice, and Varun alluded to that, is that it's the budget was a continuation of what we were actually reading from the election result, because the fact that we didn't get a single party majority, the interpretation of that could be, which we thought it would be, is that one, that the bottom of the pyramid needs support, which is what Varun's talking. So what happens is that things which have run far ahead of themselves, like defense and maybe even
rebalancing,
it kind of rebalances on this side. The other is that there is one very interesting theme which you should continue to play, and there is a report which our Insti team had written on long-term compounders. That you look through the cycle. Large themes where earnings visibility for 5 years is there, we continue to believe will continue to do well if they deliver earnings even at premium valuations. So one being financialization of savings, insurance theme is there. I think that is a long-term theme which continues to run. Similarly, this time we felt that if you slice the numbers, there's a little bit more focus on railways than roads. So on that sense, corporates which are more focused on that, and then the consumption theme which he is anyway talking about.
Right.
So it's not going to be easy, but wherever I think money will continue to chase themes where there is a story and backed by earnings, even if it is not in the short term.
That's what Deepak said right in the beginning, that time to re-look at your portfolio and get an advice, of course, on where the reallocation can be, because obviously in the next few years we will see a few sectors, they will need to rebalance, realign. The bubble that is there will, I'm not saying should burst, but will always be other sectors that are picking up and perhaps will be a better investment decision. All right, shifting gears a little, back to you, Unmesh. How would you look at the market's reaction? It was knee-jerk, and I think that happens every time after every budget. But do you foresee any long-term shifts, or do you see any market sentiment playing out? All the experts have been saying that the markets are likely to be bullish. But if there is an indication of any sort, do you see any changes likely to happen in the next few years?
See, I think given that we are now a few days from the budget, I think the obvious has been stated, which is that if you look at the long-term capital gains tax, then which is if that has moved and so has the short-term capital gains, then that has to be paid only on gains. But let me try to stir the pot here. Okay. Finally, at the end of the day, why do people invest in markets? I remember when we entered the market 20 years ago, at that point in time, people used to say you make 15-20% CAGR. That number is now 12 to 15. Yeah. And there are a lot of fund managers who talk about 12%. Actually, if you look at our, even chief economic advisor has given it that we'll grow nominal GDP at 10.5. Now, if you have a tax incidence on top of that, then your hurdle rate actually, interestingly, starts to go down in the long term. In the short term, you may be fine, but in the long term, that. The other is that 12.5 seems like an odd number. Okay, that is not to say that it is going up. Okay, that's not what I'm trying to say. But when it goes to 12.5, you always wonder whether they are going to eventually correct this to 12, or is it going to be 15 and 20 or 15 and 25. You don't know that. And on top of that is the third point, which is that there is no way, and I have a strong view on this, that there is no way that the increase in STT is the only move which is going to be there for derivatives. Because there is one very interesting point. Before the budget, for the last 3 days, you notice statements against derivatives being made by the chief economic advisor, by the finance minister in the budget, and prior to that from the SEBI chair as well. So if you put all this into context, we believe what is going to happen. If I have to speculate, I would believe that there are going to be significant moves to ensure that the speculative activity comes down, which he was alluding to in the first answer to the first question. The second is tax rates. I don't think are stable. It feels like it's going to move in a certain direction and stabilize. So that is something to be noted. Now, you put that into context of the foreign investor, because domestic mutual funds, the taxation is clear. But foreign investors in many important countries don't pay capital gains tax. So in India, when you are comparing it to another country, while yes, your returns are higher, you are paying tax on that, and that tax has gone up and possibly going up more. So does that at the margin over a long term reduce the attractiveness of India is something that I'm sure the finance ministry is also cognizant of that, but that needs to be kept in mind.
All right. So, but given this sentiment that you are talking about, we still see the budget influencing the overall growth trajectory. And some of the priorities that they have spoken about, although there are quite a few delays in the projects, and but still we are seeing the government being very bullish about their infrastructure and manufacturing projects, etc. Anything that you see from the priorities that what the government is it a continuation? I think it's more or less a continuation of the sentiment.
Yeah,
right?
I think to give credit to the government, because we were just specifically discussing taxation, to give credit to the government, the plumbing has been put in place and continues to be put in place. I think that because of the fact that tax changed, the one big thing that everyone missed or kind of noticed but did not pay enough attention to was the fact that we are firmly and truly on the path of fiscal consolidation. 4.9 was not even there in the realms of possibility. Everyone had 5 because of the one-off that came from the RBI. But 4.9 is fantastic. And all these priorities that they are talking about are all things which over the long term education, skilling, infrastructure development, crowding in the private sector, stable tax regime on everything. Other than capital gains, everything is stable. If you see, nothing's changed.
Right.
And gold has actually come down.
Yeah.
So if you look at it from that perspective, you have to give credit to the government that they are basically trying to converge everything, simplify everything, put the plumbing in place, and create an environment where today, if you look at it from an investor's perspective, when you are choosing between countries, you have a government where the sovereign balance sheet is in great shape, the corporate balance sheet is in great shape, the household balance sheet has always been okay, except at the bottom of the pyramid, and there they are supporting. So if you put that into context, the base created for the next round of earnings growth is actually very solid. And so from that perspective, it's a great country to be in. But you need to manage the short-term volatility to be able to do that.
I think one of the things that we've been reading a lot is that it is definitely a step towards acknowledging India's structural changes.
Yes.
And bringing and that all three of you have spoken about. Towards the last round of questions, I just want our audiences to have a sense of which are again the sectors that are poised for growth. What should institutional and individual investors position themselves to capitalize on these opportunities? If we could have a round on that, and then of course we'll have the closing comments.
So let me start.
Yeah.
Just to add to what Unmesh was mentioning last time, what is the difference as to your question
Right.
about this budget? The narrative, and even Varun mentioned earlier, the narrative has now changed from infra and capex
Yeah.
to building human capital and to sort of cater to the lowest end of pyramid. So in a sense it was overdue. Now it is going to happen. We should realize that infra and capex has a higher multiplier effect on GDP growth, whereas the one which we are now focusing on has a lower multiplier. So effectively, maybe a couple of years down the line, the GDP growth rate may slow down a little bit because of this shift in narrative. So, but I think everybody is cognizant of that and are hoping that the new measures will, the impact of the new measures will offset that kind of negative impact. So that is now, as far as the sectors are concerned, I think out of the budget, consumer is the most impacted positively.
Right.
Even Varun mentioned that because of the rural and agri focus, the employment linked incentive. I think that is one of the biggest impact maker measure, which will, if it is handled properly, I think it will have a very good impact over the medium term. And small sectors like aquaculture and leather and textile and all, they are okay. Outside of budget, I think IT is showing some signs of resurgence. So there one can look at that. Oil and gas looking, stock specifically, it is looking good. Defense looking overvalued. Even railway, some of the stocks are looking overvalued. And I think realty also, for the time being, I think may not perform well from here. They may consolidate for some time and then take it forward. Pharma looking good, again stock specific. Pharma you cannot generalize, I suppose. You will have to be stock specific. Yeah. Over to you guys.
Yeah, so just to add, I think pharma overall, if you have to look at, is positive only. Our view is positive. As Deepak was saying, I think if you look at the long-term trend, if we have to look through this decade, by 2030, what are the themes which are going to run, which have not got disrupted by the budget at all, frankly. So that way, I would say it was a great budget. It focused on fiscal consolidation and kept the growth priorities largely intact, with a slight nudge more towards a more balanced growth, right? Where employment generation and consequently consumption, bottom of the pyramid focus. So therefore your portfolio has to be balanced. And what would grow in India if India were to go from a $3.5 trillion economy to a $6 trillion economy in the next decade or so? Basically consumer discretionary, because as per capita income rise is about $2,500 where we are today, incrementally money goes into consumer discretionary. Your basic needs are taken care of. So that is a theme which has been continuing, and that theme is also benefiting from the formalization of the economy. So your low ticket discretionary consumption, stuff like apparel, eating out, footwear, all of these will continue to do well. Consumer durables, appliances. EVs again, government has been focusing on green energy transition in a big way. There are again explicit targets for 2030 in terms of carbon emission reduction and all, and therefore the FAME 1, FAME 2 was fairly successful, and we believe they will continue to have policy sort of framework which will benefit EVs. But EVs, you have to keep in mind that globally have started to hit a sort of a ceiling, and the penetration is not going above 15% in a lot of the developed markets as well. So a lot of the infrastructure needs to get created. So lot of these themes coming back to the same point. The themes are there, but sometimes what happens are our expectations from those themes run way ahead of reality, right? So EV, will they be more penetrated 10 years down the line? Yes. But does that mean that I go and buy every EV stock? No, because what they are building in there might be some hiccups along the exactly. So but EV as a concept, as a theme, and it may not be just EV, it could be hybrid. We believe hybrid has a great future as well. So, but green energy transition is going to happen in India and globally. And
solar,
so solar
stocks as well.
So solar, wind.
Wind.
If you look at overall, green hydrogen, a lot of work is again going on out there. So I think this whole green energy transition is again one of those themes which we are betting on. So consumerism, which is discretionary consumption, financialization of savings, so greater penetration of insurance, mutual funds compared to just bank deposits. It's a theme which will going to continue irrespective of interest rate cycles. Digitization, where digitization of land records, so a lot of niche business models benefiting from those kind of themes. So we believe one needs to have a lot of these in their portfolios and keep evaluating from time to time, because these days what happens is some of these themes tend to run so fast so soon that probably you start factoring in next 5 years of upsides right away. Then one needs to get cautious and maybe again rebalance the portfolio.
Not get into FOMOs.
Yeah. So and there is enough there are enough themes. So the good thing is what Unmesh was saying. I think economy is in great shape. If you look at the macroeconomic indicators, they are very good. Bank balance sheets are very strong, apart from the corporate and the sovereign balance sheet which we talked about. So probably after a long time, probably all three balance sheets are in the best shape that they could be, right? Currency we expect will remain stable. Trade deficit is good. Forex, our forex reserves are increasing. So I think the medium to long term path is looking quite good and clear, but does not mean there won't be bumps along the road. Valuations are high, so keep a diversified portfolio, keep evaluating your risk, don't get overexposed to one theme. Right. We strongly advise against very thematic single sector portfolios or funds for that matter, because
it's also a cycle. So
exactly. So it's better to, and the good part is there are enough engines firing in the economy for you to have exposure in multiple areas, and which will all grow if economy has to grow. So it's not that only infrastructure will take the economy forward or only consumption will take the economy forward. So
Unmesh, let me give you the last word on this. People are wondering about inflation. As to, is the budget somewhere, is the government looking at sorting that problem for people? Any insights on that?
Inflation, theoretically is never something that you can honestly beyond a point control in the short term. As we have learnt now multiple times, even in the last 4 years, it tends to be a lot stickier and it tends to move on multiple factors. Specifically in India, there are two very large components of inflation, and in India, only half of it, I think, to a large extent, can be controlled by monetary policy. The rest has to be controlled by the fiscal policy. Now, one very big factor which is not part of actually the budget at all is basically the MSP and what is happening. What the government is trying to do is that they are trying to fix the long-term issues on the inflation. So, in fact, that is what led to some of the farm protests as well, that basically trying to ensure that MSP does not, if you look at the last 10 years of history as compared to the previous 10, the MSPs have not gone up as much. At the same point in time, what the government is trying to do is ensuring, things like insurance of crops, or ensuring that
subsidization of
irrigation especially is a big one, because how much of the land is irrigated versus actually dependent on rainfall, and so on and so forth, and direct benefit transfer to. So what they are trying to do is, over a period of time, bring that inflation number down to the 4% number. Are we there? It doesn't feel like we are there yet. On top of that is the monetary policy, which is doing its job, and I think it's quite clear, because there it's mostly data dependent. So if you remove the food and fuel part out, that gets taken care of. The other important factor, which is not a part of the monetary policy, so as to speak, is fuel itself. And here again, I think we have to give a lot of credit to the government. One is that, by keeping taxes high in its own way, they have reduced, they have not, if you remember back in 2007-8, when oil prices used to go up and not get passed on to the consumer, at that point in time, the consumption used to keep rising because you were basically fueling inflation by not taking the hit. If you see what has happened this time was fascinating actually, that the fuel subsidy is such a small number, and it used to be in the lakhs of crores, and now it is down to a few thousand crores, and for anyone who's been observing this for 10 years, is actually a massive thing. So what they are trying to do is structurally derail the drivers of inflation on the food and fuel side, and then, as he was talking about more green hydrogen, more indigenization of the fuel cycle, it kind of brings inflation under control and leave the RBI to do its job on the monetary policy. I think all three are in place.
I think India overall has been faring better on inflation. You have to look at it in global context also, because a lot of it is imported inflation. But I would say inflation in India on a structural basis is not worrying us. It's actually under control. Government measures are more targeted to increase the medium-term supply. So a lot of supply side initiatives are being taken. This whole PLI, manufacturing, infrastructure creation, this all will go in terms of helping solve the long-term, and even the green energy transition, will help solve the long-term inflation problem. So I don't think we should be overly worried on inflation. We don't see that as a number one risk right now.
How do you think the global economy is looking at this, and how we are looking at global economy as well, because we have American election coming up, and so to say, as you rightly said when you were talking about inflation, that we are still better off, but the problem is happening outside our world. How are they looking at what's happening in India, and how should we be looking at their impact on our economy in the perhaps months to come?
So let me take, then you can add to whatever Unmesh will have. So globally, I think we are the best growing economy. That is a known fact. So in that sense, we have to worry only if the other part of the other countries start growing at a better rate. But at the same time, we need their support, because exports are dependent on their economies. So US economy has started growing. The latest Q2 numbers are also much better than expected, and we have the presidential elections also. Of course, we are not directly impacted by that, but I think whether the Republicans or Democrats come, there will be different impact on India's sort of flexibility, India's growth concerns, growth expectations from the global side. So that will have an impact on us. But otherwise, I think India to an extent is insulated from the global economy or global economic growth. Of course, we are getting more and more correlated or connected with the world, but we are still some time away from being too impacted by the global growth.
I think if you look at it, I'll take it one level above that. I think if you look structurally, one thing which is now becoming more and more apparent is that we are getting a soft landing in the US. Now, these things you never know till they happen, but at the same point in time, that's the direction it's going. In fact, yesterday's release also shows that the economy is broadly strong, and at the same point in time, inflation at the margin has started to come off, which means you would get, the consensus is that you will get 2 or 3 rate cuts this year, probably 2. The issue is, however, that if you look at globally, so what happens as a result of that is that the propensity to move to debt. See, because what happens is that the money first has to decide whether it goes to debt or equity. Post that, whether it comes to emerging markets or not, and within emerging markets, India is a player. So there are 3 layers at which you have to say yes, and then the money comes here. So while India is relatively better, and there's no doubt about it, but it's also one, expensive. The other is that there is a possibility of that money also moving to debt or to developed markets. So a lot of what is happening is that at the top, the interest rates now look like they will come off, which is good for generally for global equity markets. In the US, there are talks about the fact that it's only basically dominated by 8-10 stocks. So in that sense, also diversification benefit there will be some money left on the table for the emerging markets, and that is what comes to India. So generally, if you leave out the short term, which is where India looks expensive, as market starts to look at FY26 and beyond, you should start to see some kind of benefit from there. The issue, however, is that actually the only concern is that if you look at all the uncertainties today, whether it is the war, whether it is the US elections, and nothing is in the price. And every single outcome seems to be some kind of, in some kind of a perfect spot, so as to speak, like a Goldilocks kind of scenario is being priced in. Is it possible that we can get a shock from there? Answer is, if there is a very sharp change in people's view on short-term interest rates, for example, then in that case there could be, but otherwise it's going to be a slow deflation. So in that sense, India should be okay.
Got it. All right, to wrap up, word of advice to all the retail investors post the budget.
Yeah, so retail investors should sort of inculcate the habit of doing periodic asset allocation review and their portfolio review, and doing not just review but acting on it, because doing review is not enough. You will have to keep acting after doing the review and taking corrective measures. So this will help investors to get consistent returns with risk under control.
Ask questions, get your answers, and act upon it.
Right.
No, I think one thing which we can take away from the last few months is that in the long term, I think the plumbing is being put into place. So investors should remain invested. However, as Deepak says, in the short term, there is definitely pockets of overvaluation in the market. And I think that, instead of just doing thematic based investing, I think the one question that everyone needs to answer is whether the earnings will fall into place for these valuations to be justified or not. I think everyone should look at their portfolios very closely and ensure that they are buying stocks where they have very clear visibility on where the earnings will come from, because you can, and we have seen it in the market, that very small disappointments can lead to serious dislocations in valuation. So one needs to be a little bit more careful in the short term, but I think we are fine in the long term.
And we have done already a question on which sectors you should be looking at in very details. So give it a listen once again if you haven't. All right.
Yeah, so I think it's very clear from the government's and SEBI's recent statements is that they want to curb short-term investment, trading, whatever you may call, and they want to propagate, and they are not against capital markets doing well in the medium to long term, as long as it's not, a bubble is not getting created and we are not running too far ahead of ourselves. So I think anybody who has been kind of involved a lot on short-term trading, and last 3 years were too benign for anything. If you are a short-term trader, if you are an intraday trader, if you are an options trader, you might have made money, but does not mean that you will keep making money that easily in the medium to long term. So our key advice would be that start thinking more medium to long term. The less activity you do in the short term, better it is. Secondly, when you are looking at your portfolios, the way Deepak was saying, do a rebalancing, but maintain a well diversified portfolio across sectors. Don't be overexposed on one sector just because right now that's the best performing sector. The way Indian economy is, and the way Indian capital markets is compared to a lot of the other countries, it's an extremely well diversified sort of a economy and being represented in the capital markets. And given the stage of evolution that our country is in, there are multiple sectors which will do well. So have a more balanced, well diversified portfolio, and probably last 2-3 years were too easy. So if you were doing it yourself, you would have made return and you would think that you are probably very good at it. But I would advise that give it more in the hands of experts.
True.
Let mutual funds run bulk of your sort of savings because they are experts and they keep doing it day in day out, and take a medium to long term view on things rather than trying to maximize short term profits.
Wonderful. Thank you so much, gentlemen, for this mini masterclass. I think there were a lot of questions in the minds of the viewers about how to look at the budget, and also they must be reading so much and hearing so much about the budget from every other expert in town, but the real experts needed to speak. So thank you so much for your insights. Thank you for your time.
Thank you. Thanks.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.